The name is bond. Yes, it's a big day for the Indian bond markets because India enters the JPM Global Bond Index Emerging Markets, GBIEM as it's called. Now, this index is tracked by approximately $300 billion worth of global bonds. India is getting a 10% weightage, so at least around $30 billion of Indian bonds are likely to be bought. But not all that comes immediately. It's 1% weightage immediately on entry, and it increases by 1% every month till the entire 10% weightage becomes effective March 2025. But dealers say typically funds front run. So some money is already in, about $10 billion, some dealers estimate, is already in the Indian system. But not everyone is so confident that this is coming from the passive funds which follow the GBIEM. There are people who say, experts who say that many of the global funds are not registered with SEBI. It's a long process, a struggle for them to get registered first. So perhaps you will start seeing the funds trickle in a little later and not necessarily as soon as the Indian bonds enter the index. Now, not all Indian bonds are eligible for the index inclusion. Only those that are designated as fully accessible route are eligible. What is fully accessible route? Initially, some 5 years ago, a foreign fund could buy only 5% of a newly issued bond. In the budget of 2020, the finance minister changed it and said that there are some bonds which foreigners can buy without limits. Those are called the FAR bonds, or the fully accessible route bonds, and only those are included in the index. But the total amount of FAR bonds is as huge as $400 billion. Now, the FPIs, will they move the yields and the rupee? Perhaps not. The yields, already the Indian market is sitting long on bonds, and there is always fresh issuance. Per month, about $2 billion is going to flow, whereas the Indian government is selling $16 billion worth every month. So it's not going to make a very big difference in terms of yields going forward. But every time the yields rise or bond prices fall, the foreign funds are likely to come and support. So to that extent, the yields get capped, or at least the prices get a bottom. Likewise, even the rupee may not move much because the Reserve Bank doesn't want an appreciating currency. It makes the economy uncompetitive. So they may be a counter, and they may be buying dollars in the market. So perhaps not much of a change in the domestic rates or rupee immediately. But the big difference is actually medium term. In the medium term, there is one big buyer emerging for the Indian bonds, and therefore banks which own these bonds could see a bit of mark-to-market gains in their portfolio. And more important, the other indexes also come in, like the Bloomberg index. Bloomberg has also included India in their bond index starting January 2025. Other indexes can also do that. So in course of time, the number of buyers of Indian bonds increase. The Indian government has also shown a penchant for controlling its deficit. So the demand supply actually works positive for the holders of bonds. That's a stable factor. And the rupee is one big reason why foreign funds want to be in the Indian market. As more dollars come, the rupee gets more stable, and the Reserve Bank is there to kind of iron out volatility. So a stable bond, foreign exchange, and maybe a slightly falling interest rates can also mean lower cost of capital for Indian corporates. All told, we are in for a good time.